Hey, what's up, my friend? So in today's episode, I want to talk about the costly mistakes to avoid when you're trading a small account. Mistake number one, right? Not adding funds regularly to your account. Let me give you an example. Let's say you have a $5,000 trading account. You earn an average profit of about 20% a year for the next 20 years. After 20 years, right, that account, right, will grow to about $191,000. Not too shabby. But what if you add an additional $5,000 to your account every single year for the next 20 years? And again, you grow that account at the same 20% a year. How much would that be worth now? Well, based on the calculation I made earlier, it's about $1.3 million. That's more than 6 times, right, what you had previously had you not add funds to your account. So the first mistake, right, to avoid is that, you want to add funds, right, to your account regularly, right? Don't make the mistake of, just putting money and then park there and try to let it grow to like 6 or 7 figures. It can happen, it may happen, but if you want to grow your money faster, you want to add funds regularly to your account. Mistake number 2, right? You have the wrong expectations about trading. So often traders, they might start with a $1,000 account, right? And they think that, oh, okay, my account is relatively small. All I'm just hoping to make is $50 a day, or just $50 a day, right? But here's the thing, right? Your expectations of the market is irrelevant, right? The market doesn't care what you want out of it. By trying to say, you want to make $50 a day, that's like saying that your trading strategy has to work every single day. Now, let me ask you, would a trading strategy work all the time? Would it work every day? Well, for a strategy to work all the time, it means that market conditions cannot change. But as you know, right, just pull out any charts, you know that market conditions, they change all the time. Market goes from an uptrend to downtrend, range, breakout, pullback, low volatility, high volatility, etc. Market conditions are always changing. So what this means is that it doesn't matter how small, right, your expectations of the market is, right? How little, right, you want to profit from the market. It doesn't matter because your trading strategy is not going to work every single day. Doesn't matter whether you want to earn $5 a day, $50 or $5,000 a day. It's not going to care about what you want out of it. Okay, so don't make the mistake, right, of expecting to make a profit from the market every single day, no matter how small that profit is. Because your trading strategy, well, it's not going to work all the time. Not every day, maybe not even every week or every month. Mistake number 3. You think in terms of dollars. So I get it, right? With a small account, let's say $1,000, and you make $300 for the year. It might seem that, man, that's a pathetic return, right? You work so hard, follow your plan, discipline, risk management, all just for $300 a year. That's ridiculous. But if you think about this, right, that $300 is 30% of your capital. You actually made 30% for the year, and that's a return that most, if not all, I wouldn't say all, but most fund managers would kill to have for a year. And here's the thing, right? With a small account, I get it. It's very easy to look at how much you've earned, right, on a nominal basis. That's why you don't want to look at your returns on a nominal basis. You want to look at it in terms of your percentage returns, right? In fact, a better way to actually gauge your performance is in terms of R. Because percentage, there's a downside is that if you, let's say, risk 50% of your account, you make a 1 to 2 risk-reward ratio, that's 100% return, right? It might seem like a lot, but that's because you took a lot of risk to get there. So a better way to gauge your performance is in terms of R. I think this is a metric that is actually shared by Dr. Van Tarp. So how does R multiple work? So let's say you risk $1 and you make $5. The R multiple gain on that trade is $5, which is your profit divided by your initial risk, $1. So that's a gain of 5R. Let's say you risk $5 and you make $20. That's a gain of 4R. You get a picture? So what you want to do is that every year, right, you want to tabulate how many R you've earned, right, from your trading. Right, so let's say you make 25R in a given year, right? I'd say that's pretty good because if 1R is worth 1% of your account, that's pretty much 25% return for the year. And if 1R you risk 2% of your account, that's pretty much 50% return for the year. So using the R multiple approach, right, it's a more objective way to gauge your performance, right? Especially when you're trading a small account. Okay, so with that said, I have come towards the end of today's episode. If you've enjoyed it, right, hit the thumbs up button and subscribe to my YouTube channel. The link is all below, and I will talk to you soon.